In today's video, we are going to look at a simple way of using the Andrews pitchfork in alignment with some other tools and contextual price action reading in order to observe high probability trade opportunities. If you want to be able to see such opportunities, you'll need to learn how different tools come together, because using one tool only is simply not enough. We'll start this analysis by observing that price created a high volatility bar to the upside. Notice how much different this bar is from the other ones in terms of size. The logical interpretation here is that for some reason, buyers started to aggressively enter the market, and that can be the indication for an uptrend that can yield a series of easy opportunities. That's not always the case, but a massive bullish bar like that usually shows a lot of dominance of buyers over the sellers. A few bars later, we can see that this market starts to display higher highs and higher lows. And that basically confirms this first notion of buying power that was laid out by the large bullish candle. Notice that we already have two pieces of evidence for the dominance of buyers. We have the unusually large bullish bar, and right after that we have the creation of a higher high and a higher low. That begs the question of where the next low of the market will happen, because for all intents and purposes, we have an upward bias for this market unless something dramatic happens and sellers begin to show more power. Notice also that buyers accelerate in the large bar, and then their speed seems to decrease a little bit even though it's still high. That means price is now flowing smoothly instead of being in the high volatility mode of the large bullish bar. Technical tools tend to work better when price is flowing smoothly. Eventually, this current upward price vector starts to lose the momentum to the upside. It's important that you understand that buyers and sellers alternate their movement regardless of who is the dominant player. In other words, in an uptrend like this, buyers eventually stop advancing to the upside to regain their energy, and when they do that, sellers enter the stage to create a retracement. This is why price is an endless zigzag. The goal of a professional price action reading is to determine the reversal points of this zigzag motion in the most accurate way possible. At the top of the upward price vector here, we can see the formation of two bearish fractal bars. And this is an indication that buyers have exhausted their energy for the time being, and sellers are ready to create the retracement that will allow buyers to pick up their energy again. Since we are dealing with an uptrend, sellers won't be able to move much because buyers have way more power, so they will need less time to regain control. The result will be a higher low, which shows the asymmetry between the power between buyers and sellers. It's at this point that we can start using technical tools in alignment with this context we have built so far in order to pinpoint areas where price might reverse. In this particular case, we want to know where the next low will be. We can use the Andrews pitchfork in the most recent price extremes to have an indication of where the retracement will end. We do that by plotting the Andrews pitchfork in alternating highs and lows. There are countless ways of using the Andrews pitchfork, but one of the most common ones is using the central line as a parameter to know where price will run out of steam. So let's see what happens next. Here we can see an interesting effect. Notice that price began to fall and it landed exactly at the center line of the pitchfork. You might wonder how we can be sure that price will not continue to fall down beyond the center line of the Andrews pitchfork, and the answer is that we cannot really know for sure, but we can look for signs that will not happen. For example, notice that right after price touches the center line of the pitchfork, it creates an inside bar, which is an external indication that price hit a meaningful barrier. In the classic technical analysis, this inside bar is called the harami, which is a reversal pattern. Here the harami appears when price is going down, and that is a bullish reversal pattern, meaning that price will tend to go up after this. If you are a beginner or you don't know about the candlestick patterns and their flaws, check out the free course I have about that in the channel. Instead of memorizing this as a harami, we can simply infer its logic by looking at the relationship between the candle body, the tails, and the position in relation to the other candles. The bottom line here is that the pure price action is in agreement with the Andrews pitchfork reading, which by itself is in agreement with the overall context of the market. All of that takes care of the trade entry, but we still need to know if this trade has the potential to travel far enough to the upside, which it clearly does since there is no indication for the power of sellers, and we need to know if there is a logical place to put a stop loss order. If we put these three pieces together and realize that the trade has the potential for a 1 to 3 risk-reward ratio, we can assume it's a high probability trade opportunity. The only logical place to put a stop loss order in here is the last solid low, which was the last place where buyers indeed initiated an upward price vector that ended up creating a higher high. For the target, we can connect the higher lows and extrapolate the angle for the higher highs. This is just one of the ways of projecting the extension of price, of course. There are countless ways of doing that, but for this particular situation, this seems to be more appropriate. Considering that price is flowing naturally and the size of the stop loss, we can assume the upper line as a dynamic target. Given the amount of time that price takes to develop, it's not unrealistic to assume that price can hit the upper line more or less where this trade would yield a 1 to 3 risk-reward ratio. So let's see how price develops. Here you can see how this would be a successful trade. Notice that it's not just about the pitchfork or because of some setup. In order for this to work, you have to be able to identify the context of what's happening in a technical layer that explains when and where things will happen. Think of the contextual price analysis as a way of knowing what will happen, and the technical tools as a way of knowing when and where it will happen. This is of course just one of the ways of training one of the many trade scenarios that the market will throw at you. If you want to understand how to trade like this in greater detail, check out the series of courses I created in my website fractalflowpro.com. There you will find lots of information regarding what you're going to learn in each course, and also the testimonials from students who already use the methods. If you like the material I create and wish to support the channel, please click the like button, subscribe to the channel, share the video, and leave your comment below. Thank you for watching, and I hope to see you in the next video.